Welcome, everybody, to the Credit Connection. I'm here today with Henry Meier. Welcome.
Hello, Sarah.
It's great to have our legal correspondent here with us today. Henry, why don't you tell us a little bit of your background?
Well, my background, I spent a, a little more than a decade and a half with the New York Credit Union Association, where I eventually became the general counsel and senior vice president. Um, in that capacity, not only did I get to meet a bunch of wonderful and work with a bunch of wonderful credit unions, but I also um, was involved with a wide variety of legal work as well as advocacy. The legal work would often take the form of contract reviews or simply helping out small credit unions with an issue they're having. And the advocacy was uh, the type of bread and butter advocacy that we do on the state and federal level. The important the importance is not only did I do legislative lobbying, but a lot of regulatory lobbying as well. So that gave me a well-rounded background. And then about I guess, almost 2 years ago now, I went out on my own. So now I am a solo practice.
Yep. And it sounds like the New York Association kept you busy, wide variety of different things to keep you busy. So with that point of view, then what do you see as the top things coming down the pike for credit unions right now?
Well, because I do have a broad range of experience, I think you have to look at holistically to look at what the key issues are. So if you look at the one issue, for instance, everyone's talking about overdraft. So that has a that has a regulatory component to it, obviously, which is uh, what is the CFPB going to be doing. It also has, and there's also some talk about some actions being taken on the state level. There's been a lot of emphasis in California on the state level about what they might be doing to put pressure on overdraft, as well as in New York State. There's legislation that was passed that's going to allow them to cap state charters. So you have a legislative component to that. You also have a legal component to that, because even without the CFPB, you have a never-ending supply and generation of lawsuits uh, zeroing in on overdraft and whether they've been properly disclosed. And even if they have been properly disclosed, it can still be argued that they are unfair and deceptive practices. So that's one of the key issues. Another key issue, which is also going to require a holistic approach, is going to be with regard to vendor management and oversight.
Mm.
Remember that Chairman Harper has always made a big point of the fact that NCUA is the only financial regulator that doesn't have direct oversight over vendors that work with credit unions. His argument, frankly, was boosted by the fact that we had several credit unions, of more than 50 apparently, that was subject to a ransomware attack ransomware attack, which froze them out of their own core processing systems. And that underscores the importance of not only contracting with your direct vendor, as but knowing who your vendors is working with as well. So that's going to be a big area, because that's going to involve not only guidance from NCUA and graded oversight by examiners, but also it's going to put more and more emphasis on contract reviews and what is being done to ensure that what efforts are you making to oversee the actions not only of your vendor but your vendor's vendor. It's going to be a key issue. And then a third issue, which is more generally going to be an issue that has a real practical effect on credit unions going forward, is believe it or not, it's how we're all getting older. It's depressing, but the baby boomers are getting older, and as that happens, you have a tremendous amount of money, more than ever in history, really, being placed in banks and credit unions for retirement. And you have this happening precisely at the moment when it is easier, it is more than easy, it is easier than ever before for that money to be stolen in a matter of seconds. So one of the key issues is going to be who is ultimately going to be responsible for unauthorized transfer of funds. It's not going to be as clear cut as it used to be. It's not going to be as simple as, okay, you didn't give them the right to use your debit card, therefore you get the money back. No, this is going to be much more detailed, much more nuanced, and that's going to be one of the key issues as well. So if I had to list my big three, that would be it. That would be it. And then beyond that, we have issues such as I still think one that's fading kind of in the background right now because of a lack of federal action. But I still think on the state level, you're going to see increasing issues around cannabis banking, and that's gonna be a key one as well. It's also going to be interesting to see if we don't get movement in the area of data protection and data portability. If you have movement on that at the state level in the absence of federal action. So those are going to be the key issues, and they're already issues that are having a direct impact though on what credit unions should be doing to protect themselves.
You've written about this for us before, in the Credit Union Connection. In particular, you focus in on arbitration and at account opening and those contracts. How, walk us through a little bit of the basics of that and your feelings on that, because obviously there are lawsuits in that area too, is like how credit unions can use arbitration and how can they change if they need to change those contracts, things like that.
Well, one of the big changes I've seen over the time I've been in the industry is it used to be extremely difficult to find class actions brought against credit unions. And to the extent they were brought against credit unions, they tended to be the much larger ones, the biggest ones, the ones that we'd expect, such as Navy, for instance. Okay. Now what you're seeing is class action attorneys are getting more and more sophisticated. I guess you would call it. They are they are finding it more cost effective than ever, more and more cost effective to go after even smaller credit unions. So now you're seeing uh, all credit unions having to protect themselves against class action lawsuits. I I firmly believe that the most effective way, or one of the most important steps that all credit unions consider taking, if they feel that they are big enough to face the potential of class action lawsuits, is is adoption of arbitration clauses. Because what arbitration clauses allow you to do is preempt the potential of class action lawsuits, but at the same time, also ensure that there is a mechanism for that individual member to get redress against, if in fact the credit union made a mistake, yes, the members should get back uh, what that mistake cost them. What the credit unions shouldn't have to do is give millions out to class action attorneys while the members see only a fraction of that. So arbitration clauses are a key thing that all credit unions consider. Now, not surprisingly, as arbitration has become more and more common, you see a lot of pushback against arbitration. And the key point for people to keep in mind is we have a pretty good idea of what language needs to be in the arbitration clauses themselves. But what is under attack and what is going to be scrutinized is the process that was used to put members on notice and to demonstrate that members, in fact, agreed to the arbitration clause. So you're seeing a lot of litigation over seemingly esoteric issues that could have a huge impact on whether or not that arbitration clause is going to be effective. It comes down to, though, did you provide adequate notice to a member that the arbitration clause was going to be put in place, and depending on the state you live in and the type of language you've had in previous agreements, was the member given an adequate opportunity to opt out of that arbitration clause.
Mm-hmm. Now, certainly a important piece of the contract between the member and the credit union to keep track of.
Yeah,
Certainly, being member-owned institutions don't want to do things that are
exactly.
the members' interests. But yeah, so also you alluded to this when you were speaking a moment ago about other contract review for between credit unions and their vendors as well. NCUA has been looking for oversight on this for years. Why is this
Yeah,
becoming so important right now?
it's always been important to NCUA, but I think given the increasing technology, given the rush to use vendors, not the rush to use vendors, but the need to use vendors for so much more technology and banking as a service, everything. Technology is becoming such an integral part of the banking process. And because credit unions, by and large, don't have the resources to independently develop the technology or the platforms, it makes us that much more dependent as institutions on third-party vendors. So you having this increased need for third-party vendor contracts precisely when the need to oversee vendors is increasing. So in the absence of NCUA's ability to directly oversee vendors, my prediction is, and they've said as much, they are going to be doing more to scrutinize what is put in contracts to ensure that, to the fullest extent possible, um, when credit unions enter into these agreements, they do have the ability to properly monitor and at least understand what other entities are playing a role in the process. For
Mm-hmm.
instance, do they understand that yes, the contract may be with company A, but it's company B that actually oversees, let's say, the cloud service. Um, that really is a key issue. Incidentally, it's viewed. Obviously, we're talking about NCUA, but this is a huge issue for all institutions. There's actually been, um, if you have had trouble sleeping one night, you can take a look at a report that was done by the Treasury Department, and they've had a report quoting some of the largest banks in the country, saying that we don't have enough oversight over some of the biggest cloud providers. So,
Mm-hmm.
really, right now it's a contractual issue. It is one of those things that I think you might see addressed at some point in federal legislation. And what I would like to see is baseline vendor standards that we don't have to negotiate for. And that could apply not only to medium-sized vendors, but frankly, all vendors. And believe it or not, Amazon web services, Amazon cloud services, a huge vendor for all of us. We're all dependent on. So in the short term contracts, in the long term, it is something that I think should be and hopefully will be addressed in legislation.
Mm-hmm. And so speaking of technological evolution, you also were speaking a minute ago, I guess we were speaking before we started recording about Navy Federal and their situation with the elderly financial fraud case, the use of electronic funds transfer to shift money into fraudulent accounts. And then now, the Electronic Fund Transfer Act, you were saying, was passed in the 90s, or excuse me, 70s. And, it takes forever for legislation to get through and catch up to the
Yeah,
technology. So that's kind of affected as well. Can you talk a little bit about that?
yeah, it goes back to the whole issue of more generally, I think you're going to see the issue rise up, particularly with elderly, because this stories are so um, sad when you hear about someone risking and losing their life savings. I get that. Okay. Um, you're also seeing the Attorney General of New York State take an interest in these type of issues as well. And the basic idea is the Electronic Fund Transfer Act, when you think about when it was created, you had this system where, okay, I'm going to give you a debit card and you're going to be able to walk into to this kiosk and take money out, and the bank's going to have the ability to cap the amount of money you can take out of the credit union. Um, Now we have a system where members have access to fund transfer and online banking and to services that would have been core internal banking services that now are open to the public. Um, and as a result, what you're seeing is the ability of um, members to sit by a computer and transfer tens of thousands, hundreds of thousands of dollars, and businesses to do it. The Electronic Fund Transfer Act, its strict liability provisions were designed for a world in which, first of all, there wasn't that much of a scope of liability. It wasn't that great. Second of all, it was understood that the only means of accessing those funds were with that card. So it's really easy to say, well, he stole my card or she stole my card and somehow got my password. Okay. Now there are a multitude of ways that you can engage in electronic fund transfers. Okay. So how do we draw that line? And at what point are we going to pose strict liability as opposed to traditional liability where we say, no, 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 I'm afraid this happened to you, member, but remember, you did not keep up your end of the bargain. And that is what you're seeing in all this litigation. I really think that on a practical level, throw away the law as you get more and more sympathetic uh, plaintiffs, as you get that grandmother who's lost life savings. It's going to be that much more difficult for courts to say, you know, I understand what this is bad that happened to you, but it's not the credit union's responsibility. I mean, bad things happen to good people. That's going to be an issue, though, that you're going to see more and more. And in the absence of any update of these laws by Congress, it's going to get more and more tricky from a legal standpoint to figure out where is the credit union's responsibilities with regard to these type of transactions. Another great example of that has to do with Venmo and those type of services. Okay, think about that. Someone is willingly giving a third party their debit card or credit card for the purpose of facilitating transactions. This is not what was intended or thought of, conceived of when the Electronic Fund Transfer Act was created. Nevertheless, when these we have this whole litigation taking place, and fortunately, so far it's been favorable for credit unions and banks. But the litigation is, gee, someone used my Venmo account and ended up taking more money than I would have anticipated or that I should have taken. So you should be on the hook for that because that's an electronic fund transfer. Well, the question is, yes, but you gave that third party access to your debit card. So um, they are highly narrow and technical legal issues, but they have profound operational consequences for credit unions. And one of the issues is going to be, as the scope of liability increases, is this going to be another thing that makes it more and more difficult for small to medium-sized credit unions to operate cost effectively?
Yeah, absolutely. I imagine it could get some serious hits there. I
Yeah.
know my credit union has refunded a few people who were defrauded, on Zelle or whatever, but um that is something you gotta watch very carefully because it could snowball for sure.
Now,
Uh,
all these new areas, they raise issues with regard to ranging from the cost of insurance to um, to the cost of the technology you need to invest in, to the cost of the additional staff. So, unfortunately, everything we're talking about here is, if you want to look at the really big picture, yet another reason why it's getting more and more difficult for small to medium-sized credit unions to operate cost effectively.
right, right. And you see their non-interest income getting chopped away, over time, and we've got legislation from Durbin on overdrafts, that he's probably gonna try and get into some sort of omnibus bill. We've got the junk fees, quote unquote, from the CFPB. And they just announced the $8 late fee threshold, safe harbor threshold.
The larger credit unions, yeah. Yeah, what all this has in common is, first of all, you're right. Even if I agreed with the policy behind it, the timing couldn't be worse. It's interesting. These institutions, with the exception of the CFPB, the purpose of the FDIC, the purpose of the OCC, the purpose of the NCUA is primarily to ensure safety and soundness. And that whole concept seems to be taking a back seat when precisely at the moment um, when things are getting so much more expensive, when we have an unsettled economic environment. This, from a safety and soundness point, even if I agree with the underlying policy, is not the time to be going after fee income. It's not the time to be going after a source of income, which is important to many institutions. Okay, and then you look at the whole policy. Then you look at the underlying policy, and this is something I've written about as well. To me, a fundamental prerogative of any business, and I don't care if it's a credit union, bank, or Tesla, is to figure out how they are going to price their products in a way that attracts the most business, and that in a way that is fair to the membership. And with overdraft fees and other fees, what you're saying is, okay, you're going to be paying extra for the following service. Now, my criteria is, so long as someone has the option and the ability of not taking advantage of the service for which they're being paid, such as, if I don't want overdraft protection, I don't need to get it. And I don't know a account disclosure in the world that doesn't explain that to people. That should be an option that is left to the individual credit union, which has to balance how much it is going to charge against the need for keeping the business um, keeping the business going, and more importantly, for providing services in the way that their members most want it. And I've talked to several CEOs about this issue. The reality is that it's great to talk about quote unquote junk fees. These are fees that there is a demand for. Okay, if you did away with overdraft fees from many institutions, the membership would be like, there would be a core part of the membership for whom that's an essential service, and they'd want to know why you did that. So the big issue is, from a safety and soundness standpoint, this is not the time to be messing around with an important source of income. More importantly, though, even if everything was pristine, ultimately institutions should be allowed to choose for themselves with their membership, subject to proper disclosures, how they are going to provide services, how much they're going to cost, and the membership can decide for itself whether or not it wants to take advantage of those services.
Mm-hmm. And in that discussion, you excluded the CFPB. Well, when you were talking about the
Well,
safety and soundness.
specifically, I cut the CFPB slack to this extent. I say we have a CFPB primarily because of, they rightly or wrongly, they were given oversight over consumer products. Okay, right. We don't need other agencies trying to engage in Me Tooism, where okay,
Yeah.
we have our own consumer protection section as well. No, their primary job is safety and soundness. Now, don't get me wrong, I'm not letting the CFPB off the hook, but because, not from a safety and soundness standpoint, but because they are utilizing their powers in a way which is, I would argue, almost outside the authority given to them by Congress, which is a whole another issue we could spend some time talking about.
Yeah, because there's a case right now regarding the CFPB and trying to strike it down.
Yeah,
Supreme
we
Court.
have we have one of the key cases before the Supreme Court right now, for which there will be a decision, is a case in which um, the argument is that the CFPB's funding mechanism is unconstitutional. Now, As a result, you had at least one lower court that said that as a result of this constitutional defect, any rule and regulation which was passed with this money, therefore is invalid, and that would be the Armageddon. Now, based on um, what the court was saying during argument, it's highly unlikely that this case is going to be successful. But there is another group of cases before the Supreme Court in which they are going to be examining the extent to which agencies like the CFPB and like the NCUA have the authority to interpret, how broadly agencies have the right to interpret their regulations in a way that they think it should be interpreted. That, I know it could put some people to sleep, but that is actually one of the key issues that we deal with on a daily basis. And what it would do is, depending on how the court decides that issue, it could once again place more emphasis on the legislative arm of government, because the answer could be no, the statute says what it says. If you want to make this change, you got to get the change agreed to through Congress and through the state legislature. And that's why I enjoy doing, that's why I try to have just a broad practice, because there's this thought that, okay, you can be a compliance attorney, or you can be a legislative attorney, or you can be a contract attorney. The reality is, in this day and age, if you're going to be effective in any one of those fields, you have to be cognizant of each one of the areas where law regulation is being impacted and being shaped. And this is a great example, because depending on what the court rules with regard to the CFPB's power specifically, and the power of regulators in particular, it will place more emphasis on what the legislature is doing. Hey, I lobbied in New York State, and I still do some work in New York State. My clients need to know what is going on in New York State, and that's true of every credit union that needs to know what is going on in the legislative level, because and you need someone. My goal is always to bring all that knowledge together and to put it in one place and to synthesize it in a way that they can use it.
Yeah, because you can throw a bunch of money at them, or excuse me, a bunch of information at them, but if it's just a data dump, it's not helpful. It's how can they use it? How is it going to impact
Exactly.
that particular credit union?
Yeah. And one of the things I've seen in the industry in the past is, and I'm not saying this is unique to credit unions, but there is a not a by, but there is a way, there is a tendency to segregate responsibilities. Like, okay, I'm the compliance person, I'm the legal person, I'm the lobbyist, I'm the operational person. Okay, in reality, to most effectively help the credit union, all that has to be understood. So let's break down the silos and get everything into a coherent narrative where everyone can see the impact of not only responding to changes in the law and regulation, but in the best case scenario, let's position ourselves in a way that actually we can benefit from it. And to do that, we have to end this silo approach to the way we look at a lot of public policy issues in general and operational issues as well.
Yeah, it's interesting you're talking about that, because I remember speaking with the CEO of a multi-billion-dollar credit union maybe 10 years ago now, and they didn't have a compliance person at all. Like, they didn't have a lawyer on staff at all. Each line of business was responsible for its own compliance. And while people don't necessarily have to be a lawyer to be very familiar with the compliance, it seems like in today's world that just wouldn't fly.
Well, there are some wonderful compliance people. My thing is that we always try to make this distinction. Well, this is compliance, this is legal. That's another silo that I've always been interested in cutting down, because it's an impossible distinction to make. And I actually think both disciplines benefit from the other. I have a very good colleague who loves to work with, he's a lawyer, but loves to work with good compliance people because the compliance person, if they understand the law, can translate somewhat esoteric or very complicated legal things into issues, into operational protocols. That so there's a need for both of them. As a matter of fact, um, and that's the key. That's another great silo that really has to be addressed.
Mm-hmm. Yeah, and another expense for smaller cranes to be able to survive
Yeah,
too.
it is, and that's something we all have to be cognizant of.
Mm.
It's difficult. It's another reason why it is so difficult for small credit unions, and that's one of the things the NCUA has to keep in mind as well. Um, they if you not, and I'm going to get beyond overdraft. Every time they pass a regulation or come out with a guidance, um, part of that should be, um, you know, we have to start more regularly making a distinction between what credit unions have to do based on their size and sophistication, and and it has to be more clear cut than simply, well, no, create your plan based on your size and sophistication, because every time you come out with a regulation, it is an additional expense.
Mm-hmm.
And where I was trying to make that distinction before between regulatory responsibilities and safety and soundness, the old rule of thumb used to be that the smaller you are, the more we're going to be concerned primarily with safety and soundness. And in the old days, from what I've been told, it wasn't uncommon for the examiner to be the de facto compliance person. Okay, those days are over. And I think one of the things we all have to look at it from a regulatory and political standpoint is, if we truly want small credit unions to survive, and I think it is in everyone's interest that they do survive, we have to start looking at how we can more aggressively make the argument that the small credit unions in particular need mandate relief. It's something that is an argument that we have on the state level in a state like New York, which is one of the more aggressive states in terms of coming up with mandates, trying to make that distinction between the responsibility of even a $1 billion credit union and Citibank. Okay.
Mm-hmm.
On the face of it, it shouldn't be that difficult to make, but that's the problem when you have a regulatory mindset.
Mm-hmm. Which regulators are going to have.
Exactly.
So, um, so talk a little bit about like your days at the New York Credit Union Association, and what were some of the specific things that you were seeing, um, credit unions of all sizes, needing assistance with?
The one thing that there's that great quote from, I think it's Ben Franklin, we can all hang together or we can all hang separately. And the reason why, like, GAC just ended it, I know it's not probably not GAC anymore, but the Government Affairs Conference ended a few weeks ago. I always forget what the new acronym is now.
Mhm.
But the one thing that's most important, and the one thing that um, everyone can agree on, is the need to speak with one voice. There are core issues in this industry, and these core issues are best advocated for when we work as one team. So I think one area where we can all work together is, and should continue to work together, is when it comes to core advocacy issues, such as, I'll give you an example. Cannabis banking is an issue where, okay, even if you don't have any desire to get involved with banking marijuana related businesses, and even if you're small, okay, and you don't want to get involved, you have a real interest in knowing uh, what the regulations are in terms of who you can deal with, whether that member can even be given an account because they are involved in a marijuana related business. So there are issues such as that. So the number one thing would always be lobbying and regulatory advocacy. Okay, and then more generally is the issue of making sure that credit unions are not disadvantaged by the banking industry. I mean, the reality is, I used to tell people I used to love lobbying for the uh, banking industry because, excuse me, the credit union industry, because I'm not anti-bank. I'm just pro credit union. Okay, I like to say that, and I continue to believe that. But the reality is, as an industry, we have to make sure we don't bring a knife to a gunfight. Um, the banking industry, there were lobbyists who would get bonuses for ending the credit union tax exemption tomorrow. So another key issue that we can all agree on is the need to advocate and do what we can to demonstrate why we need the tax exemption. Now, when you get into more specific areas, it does get more challenging based on size because the technological needs um, of a larger credit union, for instance, might be different than a small one. That being said, I know I sound like I'm beating a dead horse here, but everyone has the issue of vendor management and how to properly oversee and vet potential vendors. So that's an issue that everyone could agree on, irrespective of size. And then the more general issue, which is always going to be challenging, is um, what is the we are a cooperative industry structured as cooperative. So how do we what obligations do we have to each other? In other words, like this is a bit controversial, but to the extent that we want to see small credit unions remain viable, are there things that we all should be doing to work together to make that a more realistic uh, possibility. So those are the issues that I think generally I always try to concentrate on, and we always try to concentrate on issues that could unite us. Those were the ones that were most common, and they all come down to recognizing where we have common values, recognizing the need to make sure that we um, continue to access and the responsibility that comes with that to the latest regulatory innovations and helping each other out when we can.
Yeah, yeah, absolutely. I agree. I love the cooperative spirit, and it is part of what will save smaller credit unions as long as we follow that philosophy.
Yeah.
So I love that. I almost feel like you already answered this one, but I always give my guests the opportunity to provide their final thoughts. So you want to wrap it up for us? What are your final thoughts today, Henry?
Yeah. My final thoughts are that it's anyone who has the opportunity to work in the financial services sector. Um, it's a fascinating field. Okay. It's a field that is impacted by technology, by business, by changes in people's thoughts and behavior towards each other, frankly, or cooperative, or people in a cooperative mood. Um, the, the need for spotting and recognizing change and responding to it and getting ready for it is going to become even more important. We actually went an entire 15 minutes without talking about AI, for instance. Okay. Bottom line is, this is an industry that's going to constantly be evolving, always has and always will. But the speed of that evolution is going to be that much quicker. So we're all fortunate to be part of it. And the more we can work with each other and make sure we have the resources to respond correctly to those changes, um, and put those changes in the context of the movement, the better off we're going to be as a whole.
Alrighty. So Henry, you brought up AI. What does that mean for the credit union field and the legal field for you?
Oh, I think it's we don't know the full extent that it is going to have an impact, but you can already see it's shaping the regulatory and legal environment with regard to banking. For instance, late last year, the several regulators, including the CFPB and the Department of Justice, um, indicated that the use of AI, for instance, doesn't excuse uh, um, compliance with the Equal Credit Opportunity Act. Okay, so so here's what I find so interesting about it in a nutshell. The whole premise of AI, or one of the possibilities of AI, is that computers may be able to discover, as a result of sifting through huge amounts of data, correlations between lending uh, and someone paying back their loan that we haven't seen before. In other words, they might come up with these incredibly complex algorithms. Now, one of the core concepts of fair lending law, particularly the ECOA, is that you need to explain in common sense terms why someone was denied a loan. Well, what are we going to do in those situations where the algorithm is so complicated? And the algorithm is constantly changing because the AI, by its very nature, is responding to changes as it gets more information. We won't be able to explain precisely why, in this situation, someone was given a loan, and in another situation, they may not. Now, I have talked to people who understand the technology much better than I do, and they do say that, no, and we're going to get to a point, and might be there already, where we will be able to explain the basis for lending decisions. But that also depends on how responsible that person putting together the algorithm or collecting the information is going to be. So, from a legal perspective, that means that it's going to make it that much more complicated and that much more challenging to um, explain and put in place a proper fair lending, a lending program that is fair lending compliant, fair lending compliant. On a more positive note, though, it does mean that perhaps with AI, perhaps with its growth of looking into um, data to the extent that human beings just have not been able to, perhaps there will be a way of expanding the availability of lending options for people who otherwise would not have the opportunity based on the traditional hand set of criteria that has been used by banking. It is interesting, though, that you're seeing this new emphasis on fair lending, not only with AI, but for instance with the NCUA. One of the emphasis they're going to be facing this year on their examiners is to more closely scrutinize fair lending examinations and fair lending decisions and programs of credit unions, as well as general compliance programs of credit unions as well. So all of this is going to come together as the banking system becomes more dependent on technology. And as members demand quicker and quicker decisions, they're going to have to be. The interplay between technology and fair lending laws and what can be expected of them is going to be one of the key issues. And is going to be one of the real interesting issues that we're going to have to look at in the coming years.
Alrighty, well, since that's your real final thought now,
Yeah,
thank you for being here today, Henry.
thank you.